Right now, as we speak, Open Door Technologies Inc., ticker symbol OPEN, is trading at exactly $7.24 per share. We are watching a significant intraday contraction of roughly 5.91%, erasing nearly 45 cents from the opening valuation. The screens are flashing red this morning, and if you are watching the order book, you can see the bid support at the $7.30 level has completely evaporated, forcing the price action to test lower liquidity zones that we haven't seen in about 3 weeks. Volume is spiking on this decline, which tells us this isn't just a casual drift lower. This is active distribution. Institutional hands are taking chips off the table, and the retail momentum that pushed this stock up from the grave earlier this year is facing its first real stress test of the quarter. The expectation right now, the narrative you will hear if you open Twitter or browse the forums, is that this pullback is just a healthy consolidation. The open army of retail traders who resurrected this stock from its 50-cent lows back in June believes that the Federal Reserve's recent dovish signaling is the green light for a massive housing turnover event. They believe that lower rates automatically equal a flooding of inventory that Open Door will capture, process, and monetize. That is the expectation. A straightforward path to recovery fueled by cheap money and a new CEO who knows how to speak the language of Silicon Valley. But the reality is far more complicated and, frankly, much more dangerous. The reality is that Open Door is not moving on housing fundamentals right now. It is moving on financial engineering. The recent issuance of tradable warrants was a brilliant maneuver to crush short sellers and spike the stock price, but it didn't sell a single extra house. We are looking at a company that has successfully engineered its stock price but has yet to prove it can engineer a profit in a stagnant housing market. The drop you are seeing today is the market waking up to the fact that a higher stock price doesn't pay the interest on the billions of dollars of homes sitting on the balance sheet. When you look at the price action over the last few hours, it becomes clear that the correlation between Open Door and the broader tech sector is breaking down. Usually, when Nvidia stock or Tesla stock are bid up on rate cut optimism, high beta names like Open Door follow suit. But today, we're seeing a decoupling. While the Nasdaq is holding relatively steady, Open Door is being punished. This suggests that the beta trade, where you just buy the riskiest asset because the market is going up, is ending for this specific ticker. If you manage your own capital through self-investing platforms, you need to understand that the volatility here is not the same as the volatility in a software company. When a software company's stock drops, their margins stay the same. When Open Door's stock drops, it can trigger financing covenants and increase their cost of capital, which directly impacts their ability to buy homes. It is a reflexive loop where the stock price actually matters for the business operations. Let's talk about who is selling today. The order flow suggests that we are seeing an exit from some of the shorter-term momentum funds that piled in during the meme rally of late 2025. These funds do not care about the long-term viability of the iBuying model. They care about trend following. And now that the trend line from the November breakout has been violated, their algorithms are hitting the sell button. If you are sitting at home using your Fidelity mobile app or checking your Robinhood fractional shares, you might be tempted to catch this falling knife. But you need to look at the volume profile. The selling volume is accelerating as the price drops, which is a bearish signal. It means buyers are not stepping in to defend the price, they are stepping back to see how low it can go. It is impossible to discuss Open Door without addressing the elephant in the room, the massive disparity between the stock's performance this year and the company's actual financial results. We are talking about a stock that is up hundreds of percent from its lows, yet revenue in the most recent quarter was down significantly year over year. This creates a tension that has to resolve eventually. Either the earnings need to explode upwards to justify the $7 price tag, or the price needs to collapse back down to match the earnings. The market is currently betting on the former, that the new Opendoor 2.0 strategy under CEO Kaz Nejatian will turn the ship around. But today's 6% drop is a crack in that confidence. It is the market asking, where is the beef? We have seen the hype, we have seen the warrants, we have seen the tweets. Now we need to see the margins. If you were comparing this to other opportunities, say Apple stock, you are comparing apples to dynamite. Apple is a fortress. Opendoor is a leverage play. But even if you look at more speculative avenues like Robinhood crypto trading or small-cap tech stocks, Opendoor stands out because its inventory is physical. It is real estate, and that real estate is stuck in a market that has frozen over. The lock-in effect, where homeowners refuse to sell because they don't want to give up their 3% mortgages, is still in full force. Even with rates ticking down, the math doesn't work for most sellers. This means Opendoor's supply of homes to buy is constrained. You cannot flip a house you cannot buy. And if you cannot buy volume, you can't cover your fixed costs. This is the fundamental disconnect that today's price action is starting to sniff out. For those of you utilizing Schwab Intelligent Portfolios or similar automated systems, you likely won't find Opendoor in those conservative allocations. This is a stock for the active manager, the person who watches the tape. And what the tape is saying today is that the easy money phase of the Opendoor recovery is over. We are now entering the show me phase. The 5.91% drop we are seeing is a repricing of risk. Investors are realizing that the warrants issued to shareholders, while a clever way to induce holding, also created a complex capital structure that will create drag on the stock price in the future. Every time the stock rallies, there is now a wall of potential dilution waiting in the wings. Let's pause on the recent news regarding the warrants because it is critical to understanding today's movement. Management essentially declared a dividend, not of cash, but of the right to buy stock later. This was interpreted by the retail crowd on SoFi Invest and Robinhood stock trading forums as a masterstroke to burn the shorts. And it worked for a few weeks. The stock went vertical. But financial engineering has a shelf life. Once the sugar high wears off, you're left with the same business metrics. And the metrics right now are showing that the spread, the difference between what Opendoor buys a house for and what they sell it for, is still too narrow to generate a real profit after you account for interest expenses and overhead. The market is efficient. It eventually looks past the gimmicks. I want you to take a second and check your portfolio. Comment below how many shares of Opendoor you currently hold, or if you are holding those new warrants. I am genuinely curious to see if the retail sentiment has shifted from hold forever to take profits in the last week. Now, let's look at the broader industry context. The real estate tech sector has been decimated over the last few years. Companies like Redfin and Zillow have had to pivot hard. Opendoor stuck to its guns on the iBuying model, but tried to make it asset-light with their new exclusives marketplace. The idea is to connect buyers and sellers directly, without Opendoor having to take the home onto its balance sheet. This is the Uber for real estate dream. If they can pull it off, the stock is a bargain at $7.24. If they can't, and they are stuck just flipping houses in a high-rate environment, the stock is a zero. The market is trying to probability weight these two outcomes. Today's selling suggests that the probability of the Uber outcome is being downgraded. We also need to talk about the mechanics of online investing in 2025. The speed at which information travels has changed the way stocks like Open trade. In the past, a bad earnings report might take days to fully digest. Now, a single data point about mortgage applications or a comment from a Fed governor causes an instant repricing. Algorithms running on interactive brokers trading platforms scan these headlines and dump inventory in milliseconds. Opendoor is particularly sensitive to this because it is viewed as a proxy for interest rates. It is effectively a leveraged bond proxy. When yields go up, Opendoor goes down. When yields go down, Opendoor goes up. But today, we're seeing yields stabilize, yet Opendoor is crashing. That is a divergence. That is a warning sign. It implies that the selling is specific to the company, not just a macro move. If you are a client of Fidelity Wealth Management or have a managed account, your advisor has probably kept you far away from this name. It is too volatile, too unproven. But for the individual trader, the volatility is the point. You buy Opendoor because you want that 10% daily swing. However, you have to be right about the direction. The danger right now is that the chart has formed a lower high on the daily time frame. We failed to break back above the $8 level last week, and now we are rotating down. If $7 breaks, the next support is substantially lower, possibly around the $6.20 mark. This technical weakness is exacerbating the fundamental concerns. Let's discuss the business